Good afternoon from my side. It's really wonderful to be here, an event on transparency and Indian wealth. I'm super happy I was invited, and I really enjoyed the presentations. I'm going to present, thanks, it's good, a very early stage project, so with very fresh result. So we were a bit ambitious when we got the invitation that we could have many tests, but as many knows, when you have administrative data and large data sets, then it takes a bit more time. So I'm going to have a couple of descriptives and some new result. I was telling everyone, be creative, it's the moment, we can explore anything, so any outcomes and any feedback you have on our preliminary result, it's really, really welcome. This is a joint project with Rebecca Lester from Stanford University, Michael Sixternier, it's a PhD student at NHH, and Barbara Sage from BU. And the title is a bit on purpose, still a bit general, local effects of global tax transparency. But let me jump to what we are interested in. So as everyone knows, the automatic exchange of information policy like FATCA and CRS has been launched to target offshore tax evasion, hidden wealth in tax haven, and from all the papers at the conference, we know that I think we can commonly say that mostly we achieved this goal, but of course we saw that there are a lot of important loopholes and where we have to work on. What we are interested here is to look at the real effects that this kind of policy tool might have on countries that are not the primary target. And in particular, with that, we are interested in the cost that financial institutions and ultimately also potential individuals are facing in countries that are not tax haven. And I just want to jump to a nice map. So this is about the data we receive from Norway. It's about the CRS and FATCA data that Norway collects on foreign residents and US citizens that have financial assets in Norway. And at least I found this map very interesting when I saw the first time, because I think everyone could imagine that so the darker the color, the more foreign assets we have in Norway from those residents. Country. So of course Sweden and Denmark is very dark, quite some European countries, also France is fairly dark, but we have also many US, in that case, citizens living in Norway being reportable under FATCA, and we have also like any country, like Russia, is very well represented in owning financial assets in Norway, and there are very few grey countries where we don't have any financial asset reported under CRS and FATCA. So I think that's an interesting starting point to say that even in those non-tax haven, we do see that there is a lot of foreign asset, and that has been then reported under CRS and FATCA. And what we are interested in, so we take the setting of FATCA because it's the first model that was launched, and then CRS is much basically following FATCA, so that we think where if there is any cost that we can imagine for financial institutions and ultimately individuals in Norway, we want to start from there. And the idea is to look at the first financial institution. There has been anecdotal evidence. One might think that Nordic financial institution already have to provide a lot of information to tax authority, but actually the survey evidence we have are exactly on Nordic financial institution, highlighting that for them was very costly to introduce FATCA and then subsequently CRS. And we want to see whether it is true on average too. So is it just survey evidence of few specific cases, or is it really true that financial institutions in those countries faced a big burden of this policy tool? And then also ultimately we want to see if it is true that we have a big cost, then does it ultimately lead to negative performance for them? And then also we are of course interested in maybe they have this cost, but they also push it to the clients. So ultimately we see that there are negative effects for the clients, foreign clients of those banks. What I'm going to present now, as I said, is mostly some descriptives of our sample and the population we have compared to the Norwegian population, and then very preliminary result. So what we find also very interesting, like when you look at Norway, there has been around 2,600 Norwegian institutions that had to report under CRS and FATCA. And I explicitly call it Norwegian institution because I'm not putting it here, but what was interesting for us is to see that actually it's not only financial institution. There were many in the transport area, in the grocery. So for example, if you are a supermarket and you run a cash benefit program, then you are subject to reporting under CRS and FATCA. Of course, then it's not substantial amount of wealth and income because you can imagine that these are very small financial asset, but still you have to review them and eventually potentially report them. So also this type of institution were subject to reviewing their clients and potentially give information. And we are talking in total on so assets that this institution have behind what is reportable CRS and FATCA of 200 billion euro approximately. And but of course, the large majority, more than 90% in terms of absolute number of reportable CRS and FATCA accounts, and in terms of the size of these accounts, are in financial institutions, as one can expect, and also of those that could be reportable, and then also those that are reportable. If you look at FATCA, 99% are in financial institutions. And when we break down those financial institutions, so who are those actors, the first line, financial service activities, where banks are. So of course there you see that they are the vast majority of, like, the big part of the entities who has to report. And also again, in terms of a total account they handle, both CRS, FATCA and domestic ones, they are the largest, and they have around 95,000 FATCA accounts they had to report, unique accounts. But there is also quite some differences. So there are also, of course, important trust and funds, also insurance and pension, quite some institution, and also quite some FATCA reports, and also from the fund management industry, especially for FATCA. So it's quite diverse, but majority is banks. And then we look at those that for us is treated. We change also the definition of treated with treated intensity, but let's say our baseline is that we consider treated if you have to at least report one FATCA client, and control if you don't have any FATCA client. And they are different, of course. So if you look at, for example, kind of some characteristic of on size, this is taken actually from the, it's called SNF corporate accounts data, but basically comes from the registry in Norway. And this is like financial information of companies as well, for example, on employees and age. So those that has foreign clients, like US reportable clients, they are larger in terms of account, employees. They are also older, so more established. And our intuition is that if you are a foreigner, you typically tend to go to a large banks that might have a more also English service. So it's not surprising. But for example, they are also performing, so return on asset, for example, is on average higher. And also those that has FATCA accounts, on average, they have around 600 FATCA accounts. But of course, in the distribution, there are some who have many, and some who have very few. And also they tend to be more leveraged. And then when we look at the clients and compare it to the Norwegian average population, so this again, because for now we'll only look at the CRS and FATCA data, so it's only about, and financial assets, it's only about the reportable financial assets. So for example, here is a bit the deposit, so the amount of money they have in deposits, and it's fairly comparable, the Norwegian average population as well as the US citizen, slightly a bit more balance account of the deposit for US citizen, but not that like on average on a big difference. And it's a bit more different in the terms of, that's the negative than balance. When we look at loan they take up, debt they take up, it's lower for US citizen compared to the Norwegian population, and that's also reflected in the in the extra debt. Extra debt is like the increase over the years. So they tend to take less extra debt, or have also in general less debt than the average Norwegian population. This is like, again, FATCA reportable individuals in Norway. And then what I'm going to present is a preliminary result on the financial institution, the cost they bear. So we have a difference analysis. As I said, as baseline, we look at treaty, those that at least have one FATCA reportable accounts and versus those that don't. But we also look at treatment intensity, and we look at, so for now we have data on payroll, so temporary, permanent costs they might incur after FATCA is introduced, as well as other operating costs, so to set up the equipment or the software to report. And then further, we want also to look at net performance in terms of return on asset or return on equity. And for us, FATCA is when in Norway they start collecting information, so the bilateral treaty is activated in 2014. We have a bunch of characteristics we control for that we also use for entropy balancing, because as you saw, they are different, so we take into consideration that, but results are also similar without entropy balancing. So we balance on account, asset, income, employees, and leverage. And our period is 2010 to 2020. And actually, we do not find significant cost. So differently from the anecdotal evidence, we don't see that they increase on average much in terms of payroll, so like long-term cost eventually. The treated versus the control after FATCA is introduced, and similar also if you look afterwards, we also put the line for CRS. But we do see that they have a minor increase or like a moderate increase in operating cost. Maybe more like temporary costs, because as you see towards the end, actually seems not to be any more statistically significant. And just the last result I want to show here is that when we use, we call credit providers, because we have information on loans they give. So this is basically, if you want, mainly banks. For them, it seems that the cost is even smaller, and just like in one period, we find that it's statistically significant. But it's a bit hard to disentangle what we want to work on more, because similarly in the other graph in the panel B, we see that it also if you have more accounts, it seems that you have less cost. So it's kind of correlates, because like banks are on average larger than the other entities. So it's something we want to work on. One might be puzzled, but because you might expect the more clients you have to report, the more cost you have, but it might not be true in a sense that if you are less, it might be more costly for you, because just for a smaller set of clients, and you might have less, like compared to large banks, already less resources in place to introduce the policy. But it's something we want to work more. And then I just want to conclude by saying that the next step we want to do is, because of course there's been also a lot of anecdotal evidence on especially US individuals saying like that they got closed the bank account, that it's very hard to have money abroad for them, and that's the natural question. If you don't see also this large cost for banks or financial institutions in general, do they translate it to their customer? So we want to see if this individual face like closing of accounts, frozen service, or reducing loan frequency, also the loan amount, as well as like interest rate, so any cost that might be borne on the clients. Because again, we have anecdotal evidence, but we want to see whether it's in average true that they face cost. And I just wanted to conclude by saying that our paper wants to really tackle this question of looking at the real effects for a country that was not the target of the policy, and whether it is true, as we see from anecdotal evidence, that financial institutions did really bear a large cost, and whether ultimately also the clients had any impact from this policy. And now I'm really looking forward to any feedback. I'm stressing again, be creative, and we are really welcome any feedback you might have.
Thanks a lot. Yeah, super interesting. When FATCA came around, we were all very impressed by these incredibly high fines, right? 20% withholding tax or something like that. So my first question is there any evidence that any bank has ever paid any fine because of FATCA? Because that is the threat that also the Norwegian institutions might face. And then relatedly, I think it's super interesting to look at this or to focus on this larger banks' results, right? So this don't seem to be random institutions. And as you point out, there were stories where Americans were denied accounts in European banks. Is there any way to look at things like account age or something like that, where you can see that when you observe the first FATCA reports, those are relatively new accounts, that could give you a hint that they have closed or had to close their previous account, just to get an idea if that's an anecdotal story or if that actually happened at large?
Thanks. On the last one, that's a really good point. I'm thinking like we have the history, so we can see once the account started there. So definitely, it's a nice heterogeneity to see which clients might be most affected by that. And sorry, the first point. The fines, that we don't have the data, but maybe there is a way to look at these two periods, because in the first 2 years there was no enforcement versus the year once the enforcement start, when they actually says like the IRS is going to put fines. So that's maybe something we can indirectly tease out. Yeah, that's a good point. But we don't have the data on the fines.
Unfortunately, we have less time for the session, so we can only take one more question.
But I'm around afterwards.
Okay. Thank you so much. I'm so excited for this paper. My name is Zorka Millen. I work on U.S. policy, including FATCA, so this is super interesting for me. I have the answer to your question, which is no withholding tax has been applied. But what I wanted to suggest for you to consider, of course, we always want to see the U.S. be more reciprocal in how it's approaching these issues. And so I think it might be interesting to, maybe you're planning to do this. I know this was focusing more on FATCA, but to kind of do a comparative, FATCA versus CRS in terms of compliance and impacts on the accounts. Because my intuition is that these kinds of whining and sob stories about Americans abroad, which we used to see in the early days of FATCA, now, more than 10 years later, this is kind of how the world works for everybody, not just Americans. So I would expect to see less of that. But I think it would be good to have some empirical evidence to back that up. So I hope that you can, do something comparing what are the impacts of FATCA versus the impacts of CRS. I don't know if that's in your plan or not, but I think it would be really interesting.
Yeah, thanks. I mean, we have the data, so definitely something very interesting to explore.
Thank you so much for the invitation to be here today. I'm going to talk about a work that I've been working on the last couple of years with Mona and with Elvin, who's also here, where we're looking into who is owning cryptocurrency. And sort of the reason that we are talking about cryptocurrency here today is that cryptocurrency is an asset that in many ways operates in the same way as this offshore financial wealth, this wealth that was held in secret bank accounts in Switzerland, other places, in the terms that it was existing outside at least the domestic financial system. It's an asset that's not within sort of the normal banking sector, where you have third-party reported information, all of these kind of things that you're used to having in a regular banking system. But there's a major difference, which I'm going to start out with, which is that the aggregate value of cryptocurrency is not hidden. You can go into CoinMarketCap and look it up. It's quite easy to find. And you will see here that cryptocurrency is a very volatile asset. So since I made my presentation last week, you see that the total market cap is here, 2.9 trillion. Today, I think it's 2.6 or something. So it's quite volatile. You have to be a risky investor to go into this market. But it's a way of both exposing yourself to the risk and rewards of this market, but also to sort of circumvent the normal financial system. So what we ask in this project is that we want to understand who owns these 3 trillions of cryptocurrency. Partly in the same way as people have been trying to understand who is owning wealth in tax havens before. But also because it's a very interesting financial question, right? So one thing is the public economics of this, but people are investing also because they want to explore this new asset. So this paper is a bit agnostic in the sense of why people are investing in cryptocurrency, but we're trying to sort of make this count of who are these people and how do their portfolio look like. And I got this question earlier today, like, how can you really know about anything about cryptocurrency owners, right? Because these are the people that have sought this asset that's supposed to be secret, supposed to be outside the financial system. But we see now there's an emerging literature, especially looking at US owners, that has used more or less innovative methods to try to understand how many are the investors, how old are they, how rich are they, etc. I'm not going to go through them here now, but you're going to see that we are trying to do sort of the same thing. But part of the literature that's looked at cryptocurrency ownership has also looked at tax compliance, which is going to be part of what we are looking at in this project. And not surprisingly, it's not very good. So we have this paper from Norway looking at Norwegian cryptocurrency owners and found that around 20% of the owners of cryptocurrency through Norwegian exchanges, so buying cryptocurrency from companies in Norway, even those had only 20% were tax compliant. And when we go to Denmark, even less compliant country it seems, we will see now from Mona afterwards that less than 10% of Danish investors declare their cryptocurrency income. So we are very mindful of that because we are a public economist. When we work with this amazing data we're going to look at, I think it's the fourth paper today that's looking at Norwegian admin data. But we're going to try to make this stock of cryptocurrency owners by both looking at the compliant owners and trying to understand using other types of data who are the non-compliant owners. And in this way sort of build this full stock of cryptocurrency owners. And what we do is that we confirm and to some degree also complement findings of the other studies from the US. That is, we show that cryptocurrency owners are primarily quite young people, but maybe young, not in like a teenager way, but more people in their 20s, 30s, early 40s. They also primarily men living in big cities. What we find, quite surprisingly, I would say, or was not my prior, is that tax compliance vary by age, but not really by wealth. And we also, to some degree, show that recent surveys that's been used a lot by tax administration are internally inconsistent when they try to measure this cryptocurrency ownership. And we add this sort of new method of trying to understand how many is actually owning cryptocurrency. So first, start out with what we can learn from the tax returns. So as of the end of 2021, which is a year that we are looking at, the point in time we are looking at, around 37,500 Norwegians declared in their tax returns that they own cryptocurrency. So this was for wealth tax purposes, meaning that they were holding it at this point in time. And this is near 1% of the population. And they own quite a lot. So you see that the median portfolio among these people is around a monthly wage in Norway, or monthly wage income, 4.5 thousand US dollars. And the average, right, so there's a lot of large portfolios in this data. So the average was around an annual wage income of 63,000 US dollars. So quite a lot. People have had, this was on one of the first peaks of cryptocurrency. You see that there's quite a lot of money stored or reported by these people at this point in time. But I said this was for wealth tax purposes, and I want to sort of point out that we see in this reporting is quite, there doesn't seem to be any sort of correlation between tax liability and reporting. So this figure shows the number of reporters in 2019, 2020, 2021, 2022. You see a big jump from 2020 to 2021. And some of these are people that also declare a net gain or a net loss during this year. But you also have a lot of new reporters that doesn't really sell or buy. So there's no new sort of realization that's going on or new tax liability that goes on. It's people starting to report their wealth. That's quite interesting. And also, we don't really see anything around meaningful around the wealth tax threshold other than sort of like a bunching on both sides. But nothing that sort of indicates that people are sort of trying to avoid paying taxes, or that sort of like the wealth tax schedule sort of selects who are in this sample. We see here this table. You can see the owners in terms of how they compare to people that own stocks, for instance, and the general population. You will see that they are quite a bit younger, more male. We see that immigrant share is quite similar, but they are more well educated and are more likely to live in Oslo, which is the capital city of Norway. The big difference here we see is then we try to look at, so here we have the assets that's reported in the wealth tax returns, and then we distribute them on age groups, right? So you see that when we take all of this cryptocurrency that is owned, you will see that the age groups 30 to 34, 35, 39, and 40 to 49, they hold, I guess that's around 75% of all cryptocurrency that's declared in their wealth tax returns. Where we look at other types of financial assets or real estate or other type of assets, you see that this is something that all the generations are owning. So there's a very big difference between the generations in who has actually went into this market. Where we'll compare this in terms of wealth groups, we don't see this difference. We see that cryptocurrency is very similar to other types of financial assets. So it's not like a financial asset that people on the bottom of the distribution go into, for instance. It's not something that's sort of people on the very top of the distribution go into. It's quite the same as other type of financial assets. So trying to understand this non-compliance. And we have the compliers already, so now we try to understand what is the total adoption in the population. And what we can see from studies that have been done is that we really have a head count of how many Norwegians have invested in cryptocurrency on Norwegian platforms, because the Norwegian government received information from the biggest Norwegian platforms for cryptocurrency trading about every buyer and seller of cryptocurrency on these platforms, which means that we basically have the microdata on how many these are. So these are a part of the cryptocurrency owning population. We know how many they are from the microdata. And then we look at surveys, because surveys sample people that own cryptocurrency in the population. And I'm not going to spend a lot of time talking about sort of how to understand this service, but what we believe is that we can get a good understanding of how many are using the specific platforms given having cryptocurrency. So what we see is that we have these basic Bayesian formulas. What we see is that 1.8% has cryptocurrency through Norwegian platforms, or the largest one of them. And we see from surveys that around 41% of cryptocurrency owners have used this platform, which means that we can sort of back out these shares of total adoption rate. And even when we add some confidence intervals based on sort of like sampling errors, we see that around 4 to 6% of the Norwegian population hold cryptocurrency at the end of 2021 using our methodology, and our main estimate is 4.9. And remember that 0.85% was declaring at this point in time, which gives us a baseline estimate of a compliance rate of 17%, which is a bit higher than sort of this Swiss bank accounts in 2007, but it's quite around what we see, for instance, for offshore real estate. I talked a little about compliance heterogeneity when we started. And what we see is that we have a lot of different sources where we look at tax compliance heterogeneity. And we see it as a quite clear and systematic pattern where people at the age of 18 to 29 or above 60 have a much lower compliance rate indicated by these sources than people sort of in middle age groups. Where we look at wealth, for instance, we don't see this variation. It's mainly an age phenomenon. So we use these insights to create some sort of figures that I'm going to show you here at the end. So first we try to see, okay, how does sort of like this likelihood of owning cryptocurrency change across population groups when we use sort of these compliance rates that we have adjusted for sort of the age heterogeneity. And what we see is that it's not really these age groups between 30 and 39, which is the main group when we look at likelihood. It's a group below 30. So you have a lot of people underreporting below the age of 30. Also someone above 60, but that's not as meaningful. And in terms of dollar terms, it's not as meaningful also this under 30 really. It's mainly in the group 30 to 39 and you see these large fortunes. The last thing I'm going to show is this distribution across wealth groups. So here's just likelihood. And we see that when we try to use this age-dependent correction rate, we find quite the same sort of wealth gradient that we did for reported cryptocurrency. We see that when we do this, we find that in the top 0.1%, more than 10% of this group seems to own cryptocurrency using this methodology. So it's very much an asset that's follow what we know from before about other types of financial assets. It's more concentrated at the top. So yeah, I think my time's up. So this main insights. Thank you so much.
Thank you very much. What ownership rates do the survey findings indicate for cryptocurrency compared to the 4.9% you estimate?
So surveys from Norway typically find around 10%. So there's quite an overestimation, right? And if you think about it for the tax administration perspective, right, there's almost double as many people that you're looking for if you believe it's 10% and it's 5%, right? So it can be quite large, yeah.
Hi, did you look at anything at corporate ownership of crypto?
We tried to look into it. We see that it's not as evident or there's not the same tax reporting for it. But there's also tax benefits accruing to having it on your own in a sense because you have to pay corporate income tax on it if you own it through a corporation. In Norway, so you don't have the same like holding company benefits as you have for other type of assets. Yeah.
Thanks. Fascinating results. So, thinking about the usual wealth and the usual age distribution of wealth, and you have a real estate asset that's inherited when someone turns 65 or something like that. Isn't it nice that we finally have an asset that's not held by retirees? And what does that mean for productivity?
So, the very speculative approach here is that this is a new asset that the smart people of the young ages have bought. And if this just continued, then you would, like the supply is fixed, right? So you could, if you want to invest, this is not investment advice, you could say that more new generations is going to invest into this, right? And if the younger people that were young but become old, keep on to it, then you would assume that prices would sort of like secularly increase over time. I don't remember quite the finance profession finance journals have found a very good word for sort of like calling this a pyramid scheme without calling it a pyramid scheme. But they have some, I think it's like momentum-like strategies, which is like a euphemism here. But so of course we shouldn't delve too much into like how do we value this, but it's very interesting to see sort of like how this persists over time, if this is going to persist or if it's going to be sort of adopted by new generations as well.
Very quick.
Okay. Thanks. Do you see any effects kind of coinciding with transparency reforms for other types of assets like bank accounts?
There are some minor results showing that people that are sort of treated by, they're informed about the CRS information, for instance. You see that they also report their crypto. But we haven't sort of found any causal results on that yet. But yeah, there's something to look into there. But of course, it's a hard field to maneuver in a sense because everything is depending on declaration, right, and self-declaration.
Thank you very much.
Thank you.
Hello, I'm very happy to be here. And Andreas already kind of did an introduction for my presentation. So this is a second project I'm working on crypto, and it's a joint work with Hjalte, who is also here. And so in this paper, we're going to look at cryptocurrencies, but from a Danish perspective. Okay. Yes, okay. So as you now already know, why we are interested in crypto? First of all, because it has a secrecy component with respect to other type of assets. So it is still highly secretive. And the second also important thing about it is that its adoption was growing largely. So for example, from, as you can see, $0 in 2016 approximately, and with this boom that Andreas showed before of around like 4 trillion by the end of 2024. And it is, like, according to surveys, 10% of US households own crypto now. Now, as you know, third-party reporting and information is key for tax enforcement, and so far there is no third-party reporting on crypto yet. So it is probably going to come with CARF, which is an OECD proposal on, that allows the governments to access these information on crypto asset owners via the centralized platforms. But so far, this has not entered in force, and therefore there is still the secrecy component around crypto. So what do we do? There is like a very interesting setup that arose in Denmark, which consists of the Danish tax administration forcing the domestic crypto platforms to send all of the information on investors. So now it's like a third-party information that arose in Denmark only for domestic platforms. So if someone is investing on foreign platforms, they remain their investments remain opaque, secret. But if you are investing on domestic platforms, now the government, the tax administration can see what you're doing. So we use this rare, very interesting setup and crackdown by the Danish tax administration in order to obtain these data. It's also interesting because it's an unanticipated shock. So it was suddenly announced that in 2019, the tax administration has received this information back from 2016 until 2019. And then they did the same in 2022, where they also got the rest of the data. So our data will span from 2016 to 2022 or 2021. Yes, also a very interesting, very important thing to mention is that how do people trade, how do people acquire crypto? So most of them, I mean, at least 80% of crypto investors, they buy through centralized platforms because it's easier. So you just go, let's say, to Binance or any platform and you buy crypto, and some others, which is estimated around 20%. This is not our estimates, it's based on surveys. Here it's based on the tax administration estimations. So they say peer-to-peer transaction, they account for 20%. Why this distinction is very important? Because on centralized platforms, you have the KYC, know your customer. So most probably when people sign up to buy crypto, they put their real name, etc. And in case one day third-party reporting is enforced, this is very easy to know who is investing on these centralized platforms. But in peer-to-peer transactions, this is not the case because it can be through persons or informal channels or etc. So this is just a very important distinction. But since most of the persons are going through the centralized platforms, we can catch most of the people, at least for now, if they don't move to peer-to-peer transactions. So what do we do in this paper? So because we have this interesting setup that the Danish tax administration cracked down on the domestic platform investors, now we have this data. We can use it first to see who are these crypto users based on real data, not on surveys. We can also check if they are tax compliant because we can observe who is buying and link it to the tax records in Denmark. And we can also see if it has like effect on shifting the activity from the domestic platforms to foreign platforms. Self-reporting, does it increase, etc. So we're going to see this later on in the presentation. So three main sources of data, as I mentioned, the Danish domestic crypto platforms, the Danish tax registers where you can find the wealth, income, and like different variables, and then a very important database, cross-border bank transfers. So this database actually is our proxy for the foreign platform use, because as you know, we have, okay, the tax administration now can see your domestic transactions, but they cannot see the foreign ones. But indirectly, because when you are, let's say you want to use Binance, you are transferring money to Binance, so we can catch this in the bank transfers, the transfers that are going in and going out from your bank account, and this is our proxy for the use of foreign platforms. So what are the data from the Danish platforms? Like what does it contain? It has the amount sold, bought, the crypto type, like is it Bitcoin or Ethereum or etc., the name, the birth date of the person, and sometimes the tax identifier of the person. So again, the data was retrieved by the Danish tax authorities in 2019 and again in 2022, as I mentioned before. So the database spans from 2016 to 2021. And we have around 30,000 customers that are on these Danish platforms. You're going to ask me how much they represent from the whole Danish investors. So we are not sure because we don't know how many people invest in crypto, of course. But according to surveys from the Danish tax administration, they suspect that around 500,000 persons have crypto. So this leaves us with around, we're covering 6% with these domestic platforms. Yes, so this is the first database. And the second database that I mentioned is the cross-border bank transfers. So this is, we can observe the transfers from the largest Danish banks from 25 to 2022. We can merge them with the tax returns and the crypto transactions. So now we can see the person, his domestic investments, his foreign investments in a way, and his tax records as well. So three databases merged. And this is just like some descriptives from the bank transfers. So you can see that there is a peak, and this Andreas mentioned this peak before. This is because in 2017 there was like a huge increase of Bitcoin price, and everyone was buying Bitcoin. So that's why it looks a bit weird. But here you can basically see the number of people that are transferring money to and from the foreign platforms. And now, like, also this is a bit similar to what we find in the paper that Andreas presented. Who are these crypto investors? Like some descriptives around them. So they are younger. So here we have the full population and our crypto investors on the domestic platforms. The crypto investors are younger. They are male, like 87%. They own more stocks. They are not necessarily wealthier, and they seem to be more in depth as well. Let me just see. So here I cannot click, unfortunately, on the links, but I'm gonna have to. There's a very interesting descriptors that I want to show you in the appendix. So yes, this is also like similar to what Andreas mentioned. Along the wealth distribution, here we have in blue the crypto ownership, and we have in red the stocks. So in the stocks ownership, around 80% of stocks are held by the wealthiest 10%, but in crypto it is much less. Of course, it is still concentrated, but not as much as stocks. So we have around 40% of crypto that is owned by the 10%, and you can see that in the other less wealthier, in the bottom of the distribution, you have also much more blue than, so much more crypto wealth than stocks. And this is a bit similar, like a similar message. So here we are looking at the portfolio of people along the wealth distribution. So you can see that in the bottom of the distribution, around 50% of the portfolio is crypto, but on the top of the distribution, it's mostly stocks. Now I'm gonna go back to the presentation. Yes, so now after we had an idea who are these crypto investors, we're gonna ask, are they tax compliant? So this is easy because we can see their investments on the domestic platforms, and we can see their tax records. So we take like a very simple way. In Denmark, if you sell crypto, you need to either report a gain or a loss. So you're obliged to report one of the two. If you made a loss, you report the loss. If you made the gain, you have to report it. So we define our tax non-compliers as those persons that sold crypto but did not report neither a gain or a loss. And we find, strikingly, that 93% of crypto investors selling did not report. We wanted to dig a bit deeper into understanding why, understanding this result. And we find that along the years, this is relatively stable, around 90% of people not reporting. But if you switch from the number of people reporting to the amount of the sale that is non-compliant, you can see that there is a decline. And I'm not going to show you here because also I need to skip to the appendix and go back, but because I cannot click the links here. But the thing is that we find why there's this declining when we look at the amount of sales, because those at the top of the distribution, they are the ones who are doing large sales, and probably they are a bit more aware that the tax administration can flag them more easily than those in the bottom of the distribution. So it is these people that are in the top of the distribution that are kind of being more compliant than those at the bottom, just because they are making larger sales. Now, how do these investors report to the third-party reporting? So we were thinking of the different responses, behavioral responses after this crackdown. So, investors have different strategies. Either they can shift now the investments to foreign platforms, or they can start self-reporting. They can stop crypto investing. They can keep the non-compliant activity. So there's several options that we can explore. And again, so we can, thanks to these, to the proxy of the bank transfers, we are able to have this defensive setup where we have the treated group, which are the crypto investors in Danish and foreign platforms. So we are observing someone who is investing on a Danish platform, and also we can see what he is doing, like in his bank transfers, so on foreign platforms. And we have another group, which is the control, which are individuals that are only investing on foreign platforms. And we can, compare these two groups before and after the crackdown. So what happens? This is just like some descriptives of, so you have the crackdown that happened in 2019. Before the announcement, we have some parallel trends. This is, again, this peak is from, because there was a lot of, as I mentioned to you before, a lot of investors that bought around 2017, 2018, because the Bitcoin price was increasing like a lot. But the assuring thing is that we have parallel trends, even if they are a bit weird. And then after the crackdown, you can see that those that are our control group, which is the blue line, the foreign platform investors, is relatively okay, like kind of stable, let's say. And then you have the red line, which is those that are on Danish platforms. They increased much more their bank transfers to the foreign platforms than those that are only on the foreign platforms. So we are suspecting that that individuals that are on these domestic platforms are shifting now to from where now there's more transparency to a more opaque platforms. And we also are so this is still work in progress. We are looking at self-reporting. So those that are on the domestic platforms, are they self-reporting more than those that are on the foreign platforms? And we can see that yes, after the crackdown which happened, we can see that after 2019, those that are on the red line, so the Danish ones are self-reporting much more than those on the foreign platforms. So this is also indirectly an indication that those on the foreign platforms know that they are still protected and there's still more secrecy, and that the tax administration cannot yet know what they have. So just to sum up, since the time is already almost up, more than 90% of the crypto investors do not self-report their income. More transparency via third-party reporting is, of course, needed. But this third-party reporting, if it's not global, investors can easily shift to other countries. And there's another layer of complexity, even if all countries agree on CARF or on any other transparency measure. There is the centralized versus peer-to-peer crypto. So okay, you can solve the centralized crypto part. You can see who are the customers, but not sure about the peer-to-peer part. Thank you so much.
Thanks. I was wondering, when you talk about the non-compliance, do you have a breakdown of how many people actually made a gain versus how many people made a loss, and how non-compliance looks like that broken down? Right? Because the people who made a gain, they actually owe tax. The people who made a loss, they may not have declared it, but they didn't owe tax either because they made a loss. And then maybe some back of the envelope calculation of how much tax actually wasn't paid, or how much of a loss there was for the Danish government. I think that would be helpful.
I think we did this before, and the results were almost the same. I think you mean if we exclude those that did some losses, will it impact? Will we see different results from those that made gains? But if I recall well, we didn't include these in the paper, but we did them. It's still basically both groups are non-compliant.
Yeah, thanks so much for the organizers for having me. And before I start, I have to give the disclaimer that basically all of this is my opinion and not that of the IMF. Okay. So what's this paper really about? And I think the other papers have set the stage kind of nicely, is that there's kind of universal calls that crypto assets should be monitored better, and people want to kind of figure out who owns them and how do they get sent around. And there's a literature, and I think I'm contributing to that, that their crypto assets are used increasingly to send money around internationally. And actually within this paper, I'm going to break down kind of $2 trillion of crypto asset flows, more specifically stablecoins. So stablecoins are crypto assets that are supposed to be pegged one-to-one, typically to the dollar. The two largest ones would be USDC, Circle, and USDT Tether. So this is really only about stablecoins, so there isn't really a speculative motive in this. The main problem that you encounter typically is that people will tell you, quote unquote, crypto is anonymous. But what I always argue is that this is quite a misconception. And that the better description is really that crypto is pseudonymous but not anonymous. And the difference here really is that in crypto, actually every transaction is publicly recorded. You can look this up at any point in time. Yeah, but it's not very useful because you just see a bunch of random numbers and letters. So what you would typically see, and this is where the first contribution of the paper comes in, is you would see like this blue guy, a blue wallet, and you just see like 0x1234 blah blah blah. And then you see the gray person, 0x5678 blah blah blah, and $100 was sent from blue to gray. So what the paper does, it develops a novel methodology to estimate the geography of the blue guy and the gray guy, and think in terms of geographic regions of these crypto wallets, really. So, yeah, what I use is kind of a blend of AI and machine learning to come up with estimates, for example, that this blue guy might be located in North America and the gray person was located in Latin America. Then I use this to estimate international stablecoin flows, and what we really find is that most flows are inter-regional, so they cross like these large geographic boundaries. And when you net out the flows, kind of the picture becomes very distinct in terms of that all the crypto flows, or the stablecoin flows to be more specific, are actually net outflows from North America to other regions around the world. And then depending on if I have time later, there's a bit of analysis of drivers of those stablecoin flows. I'll present some evidence that stablecoins seem to be satisfying some of the dollar demand that is kind of well documented around the world, and that you can also see the 2023 US banking crisis in those stablecoin flows. Now let me skip the literature in the interest of time. Maybe very briefly, how does an international stablecoin flow work? So suppose you have the yellow region, region A, blue region, region B, and the yellow region has a sender who wants to send money to a receiver in the blue region. Typically, the first thing that you do is you take fiat money and you deposit this into a crypto exchange, something like Binance or so on. Yeah? And then from this crypto exchange, there are a couple of different options. For example, you could send it, you're on Binance, your friend is on Coinbase, you send it from Binance to Coinbase, and then that person withdraws from Coinbase into fiat. You could go through a self-custodial wallet or not. But kind of long story short, what we observe for this data set is really everything that is kind of on-chain, but not the fiat side of this, right? So I don't have data on who sends money to Binance, but I can tell you like where Binance is sending the money to and so on. Okay, so the data that we're using is kind of full copies of a couple of different blockchains. So the biggest ones, Ethereum, Binance Smart Chain, and so on. And it's actually a huge data set. So once you finish kind of scraping all of this data, this is end of 2024, you get 12 billion crypto transactions. Not all of them are stable coins, right? There's a bunch of other crypto stuff, and you have like 22 terabytes of data to analyze. So you need to dig through that, and then there's some supplemental data of some wallets that are labeled that I'm using, and so on, and some things for regressions. Okay, so how do you actually estimate the geography of crypto wallets given that they're supposed to be quote unquote anonymous? So the approach has 3 steps. First, I'm creating some training data by identifying the geographic region of some wallets, so kind of a subset where I think I get a better estimate. Then I train a machine learning model that basically recognizes patterns of what people typically like to do in certain regions when they use stablecoins or crypto in general. And then I can predict the region of an arbitrary wallet, even though I might not have at the start had a good idea of where they're from. Okay, so how do you get the training data? There's 2 approaches to that. So the first is, I would assume most people are not aware, but you can actually buy a domain name for your crypto wallet. So that instead of 0x1234, you can buy a domain name similar to how you buy a domain name for your website. Okay? And you can pick a domain. What I do and what the assumption here is that people oftentimes pick domains that are meaningful to them, and therefore they often have geographic information in there. So for example, you can register a domain that is entirely written in Chinese characters, but I guess in this room, unless you're Chinese somehow by ethnicity, you wouldn't typically do that. And there's a lot of other things. And so I have around 6 million domains, and I can't really do that by hand, so I ask LLMs to kind of make guesses of that. And there's some wallets that interact a lot with regional crypto exchanges, like a Danish one, for example, and then you can be reasonably certain that there might be in Denmark. Then the machine learning model basically uses certain features. For example, one thing that is very intuitive, but it's kind of predictive, is what time of day are you doing your crypto transactions, right? Because intuitively, right, the daytime in the US or in Europe is typically like the nighttime in Asia, and people are not really as active during the night as they are during the day. Whether or not daylight savings time has an influence on your trading, right? In Europe and the US, you have daylight savings time, but for example, in Asia, it's basically non-existent, and some other characteristics. And then when you predict, you have to kind of buy the identifying assumption that conditional on the features that I'm using, the wallets that have a domain name, for example, are the same as the ones that don't. That's why I don't use something like transaction sizing and so on, because I'm worried, because you have to buy domain names, that there might be selection effects there. Okay, it's kind of unusual, I think, to just throw domain names into an LLM. So let's maybe look at a couple of the outputs. So when I put the domain names into an LLM, I ask basically for 5 things. Or I give 4 things. I give 1 thing and ask for 4 more. So I give the domain name. Then I ask, give me a geographic region that you think that person is in. Give me a country that you think that person is in. What language the domain name is written in, and a reason why you do that, so I can kind of at least check a bit what the LLM was thinking. So you see kind of the first domain name looks very nondescript, right? And the LLM agrees, like actually you can't really infer anything from this. But then the second and third, they're kind of more interesting, right? The second one is written entirely in Arabic script, and the LLM recognizes that, says, Arabic is mostly spoken in Africa and the Middle East. Translation apparently is chemicals, which is not descript enough to give a country estimate, but at least, regionally we get something. And then the third seems to mean beer in Chinese. So it's kind of saying, this, my guess is kind of in China. I want to kind of spend a bit of time to convince you that this isn't crazy, that this actually works. So the next thing that you can do is, okay, you believe the LLM, and then you take everybody's kind of histogram by what time of day they're active, and then you plot that, right? And for all the regions, I basically on the x-axis converted into local time, think like a time zone roughly in the middle of the region, and then the percentage of transactions that happen depending on the time. And you kind of see a distinct pattern that's pretty intuitive, that during the night there's a distinct dip in activity, right? And then once the day starts, people start doing their thing again, and this works, right? Otherwise, if it would be systematically wrong, like the dip would be at a time that doesn't make any sense, like 3 p.m., or you would see something that's very flat in terms of that. This doesn't seem to work, but this is kind of my first check. This kind of seems to work roughly. Next thing is, okay, now you can do daylight savings time. So for the wallets that the LLM thinks are in North America, when you break this down by the different times of daylight savings time, you see basically an offset by exactly 1 hour, which is what you would expect, right? Because there's 1 hour daylight savings time. If you do this kind of placebo test-wise for Asia, it doesn't happen. There is no daylight savings time in Asia, right? So kind of on average, this seems to work. Okay, so once you buy this and you do this, you get around 346,000 wallets training data. I do like a 90-10 training testing split. The model that I train is called a gradient boosted decision tree. It's a bit fancier of a random forest. And I basically, I'm not that ambitious yet. I'm just asking for 5 broad geographic regions. So Africa and Middle East, Asia and Pacific, Europe, North America, Latin America, and Caribbean. When you do this, you get evaluation on the training data, testing data. You're around 65% accurate, and there's a bit of heterogeneity. This kind of works best for Asia, and for Africa and the Middle East, you're a bit less accurate. But on average, you're picking up something meaningful. So this is kind of why I like it. All right. So now, if you actually have an estimate of where the different wallets are, the nice thing is with blockchain data, you get the full transaction level data, so you can just merge your estimates onto your transaction level data and kind of calculate how stablecoins flow around the world. So let me give you a couple of stylized facts. We capture around 138 million stablecoin transactions, $2 trillion in volume. The average transaction is something like $14,000. I think the median is like $150 or something, so there's kind of huge tails, right? The largest absolute volumes you do find in North America and Asia, but when you kind of try to set this a bit relative, for example, to GDP, you do find that stablecoin usage seems to be highest in Africa and Latin America. So there's 59% is roughly USDT, which is kind of the bigger of the two stable coins. 40% is USDC in this sample. And if you were to kind of give the average profile, it is like you like using Binance and USDT if you are from a region that has many emerging markets, so like Africa or Latin America. And you like using USDC and Coinbase if you are from a region that has your AEs, your advanced economies, so North America, Europe. Most flows are interregional, as I had said, kind of highlighting a cross-border use of this, and net flows go from North America to all other regions. I think I still have maybe 5 minutes or something. 2.5. 2.5, okay. So when you actually plot this, you can find the paper online. It kind of looks a bit wild, but it's kind of the flow diagram of everything that goes on. You see most of these things are not within the region, but they go across regions. Right, and you kind of see the relative sizing that I've talked about. When you go ahead and net out all the flows, you can actually see like everything goes from North America to other places where people typically like to have dollars. I guess that's not new to crypto. That's kind of a longer standing thing in international macro. Paper has many more breakdowns. Let me use the last 2 minutes to kind of show some regressions. Not putting too much kind of weight on them, but just trying to highlight some drivers. So the first thing that I should mention is I did actually run another model to distinguish China from the rest of Asia. And then what I run is a regression that looks at kind of these net flows going from North America and Binance, because Binance is quite important for China, versus the exchange rate of the dollar versus the Chinese currency. Right, to kind of look into this hypothesis that stablecoins seem to be satisfying some of the dollar demand. Right, China has quite a closed capital account. It's pretty hard to get dollars in China. So I do this, and you do see that whenever kind of the dollar appreciates versus the Chinese currency, right, that's when you would want to hold the dollar more. There's actually more dollars flowing into China. That's kind of the estimate that I have here. And maybe the last 1 minute I'll use on kind of the banking crisis. So in 2023, you had this US banking crisis. I think most economists are aware, but you might not be aware that many of those banks were actually banks that were handling crypto clients. So kind of the hypothesis is that this banking crisis really specifically disrupted stablecoin flows that come from North America, right? Because that's where the crisis was. So we run a fairly standard diff and diff with North America as treated, the others as control, and you do kind of see that you have your parallel trends before the crisis, and then once the crisis hits, stablecoin flows from North America actually fall off a cliff. It's like a 8 standard deviations treatment effect here. So this was quite significant, and the reason is basically if you are in the stablecoin business, you're really intermediating fiat dollars for crypto dollars, right? So if the fiat side of your business goes bust, you're in trouble, right? Because you can't do this transformation between fiat and crypto anymore. Let me just put the conclusion up and then maybe take some questions. Thanks for having me.
Thanks for a nice presentation. So what about within exchange transactions? So do you observe that? Like someone sending from like a Binance account sending stablecoin to another Binance account? My impression is that that happens a lot, and that's a big part of the market.
Yeah, so what is purely within an exchange we don't observe because there's no on-chain transaction. So that we don't observe now. So in some sense, think of this as like a lower bound estimate.
Thank you for, yeah, this is super fascinating. Do you have any intuition for how we should think about uncertainty in this setting? It's clear that you're using all, I would imagine, like all the available information to like its fullest potential. But I think like at the same time, it doesn't seem like that much information. You'd probably like be confounded across longitudes, obviously not latitudes, but and I would also imagine that like the false negatives off of names are probably really hard to deal with.
Yeah, so the paper does have a bit more of that. In terms of kind of right, I use time zones a lot, but of course North America and Latin America share a time zone, for example, and Europe and Africa share time zones largely. So the way it actually works is you do this estimation in 2 steps, where first you bunch North America and Latin America and Europe and Africa, so that you can exploit the time zones perfectly, or as much as you can. And then I estimate models that divvy out those 2 continents from each other. And most of the useful variables there are actually what exchanges do you like to use and what do you actually like to do, but not what time of day you're active. And then in terms of the kind of false negatives and so on, the paper has kind of more data on the confusion matrix. And you do see like the false negatives, false positives, and so on there. They're not completely random, so you do see kind of some biases in there. But I don't have a good way of correcting for them apart from listing them. Let's say it like that.
Okay. Thank you for the presentation. I was wondering whether you could do the same for all cryptocurrencies. You don't do it because it has the direct connection to real economy via dollar, or are there other reasons?
Yes, you can do this for other cryptocurrencies as well. The reason I'm not doing this is that when you actually look at the flow volumes, even though stablecoins have much smaller market capitalization, they account for much more of the flow volumes. So like Bitcoin is, I think, like 4 or 5x the market capitalization, but stablecoins are actually like 8 or 10x the flow volume. So there's much more flow volume going on in stablecoins. So this seems to be kind of the first order thing to look at when you want to see crypto flowing across borders.